Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani here. I hope you're doing great in the markets and the markets are treating you well. Your trading and investments are appreciating well. In this video, I want to touch upon a topic which I have mentioned before, and I do feel it's time to brush up the same again because the time is right, the market is right, and of course, you've already had time to observe whether this hypothesis is working well or not. Friends, I've recorded videos about why the index, at least India specific, is a far better bet in terms of volatility and in terms of giving you far lesser stress in appreciating as compared to individual stocks. My first video was on 4th of Jan 2021 on whether indices are better than stocks, and on 1st April 2021 I recorded another video which you can kindly scroll down in this playlist. It was titled "If the Markets Fall, I Will Do This." And then again I recorded another video subsequently giving you the names of a couple of good Nifty ETFs. So I want to brush up about why I think it is time to take exposure if you haven't already done so, and if you have done so, maybe it's time to increase or up your allocation onto the Nifty ETFs. You see, in our country, the Nifty ETF specifically is made up of 50 stocks. Now, these are called the constituents. Now, these constituents have a weightage, and therefore it is not an equal weightage index where all 50 items have a uniform 2% weightage, and therefore when the stocks go up and down, the Nifty reacts accordingly. Now, herein lies the difference as to why I recommend for risk-averse investors a Nifty ETF as compared to individual stocks. If you're a trader, a short-term trader who's seeking thrills and higher volatility, because that's where money comes from, obviously you will prefer individual stocks. But for people who want to sit back, relax, and earn a return in a little more steady manner, the Nifty ETF is the ideal instrument. In India, on an average, the index fluctuates approximately, I'm using the word approximately here, about 1.25% on an intraday basis. But an individual stock gyrates by over 3% on an intraday basis. So if you're somebody who can't stand the volatility, whose basically stomach is not geared up to handle this kind of up and down on an intraday basis, the Nifty becomes ideal. And any investor or trader with a little bit of understanding of statistics will realize that volatility can cut both ways. So you're obviously looking at a little more stable way of earning money. And as you grow older, you start to realize that growing on a year-on-year basis with less volatility is far more peaceful as compared to going up one month and down the next and going up again in the third. So why am I recommending the Nifty ETFs? Because these 50 stocks are not uniformly weighted. That is number one. Number two, the weighted changes from month to month. There is a reward and there is a punitive action here. You can, in the video of 1st of April, I have mentioned the URL or the link to NSE's website where you can check out the weightages of the Nifty constituents on a month-on-month basis. These are revised every month. Yes, you heard that right. These are revised every month. And the stock that has gained in the previous month is assigned a higher weightage in the following month. And the stock that falls in the previous month, its weightage is reduced in the following month. So the idea is to blunt the fall of the Nifty in a falling month and accelerate the rise of the Nifty in a rising month. And this is the way the system operates, and this is something that works to the advantage of the buy and hold investor / trader. Now, trading the Nifty in the futures or on the options segment costs money because you will be rolling over from one month to the next. In options, you will see erosion of the premium due to time decay. But if you are to buy an ETF, it will lie dormant in your demat account just like any other equity stock. You would have paid it fully, and therefore when you sell, you get the profits without any financing cost. And of course, the usual long-term capital gain protection also works in your favor. Now, I also remember telling you that this ETF is the favored choice of one of the savviest category of investors out there. I'm talking of the government babus whose retiral money to the extent of over 2 lakh crores is invested in the ETF. And I believe that these are the savviest investors around who are averse to the idea of seeing erosion of their capital. And if they are betting heavily on the Nifty ETF by way of their Provident Fund investments here, it makes sense for you and me as common retail investors to follow the simply far superior, wiser guys who know where they are putting their money and ride the coattails of their profitable journey. And now that the volatility in the market is escalating, it would be an even better time to find a safe haven which is far less volatile. Remember, the volatility of an individual stock is approximately 2.5 to 3 times, not percent, but 3 times more than the Nifty. This would be an ideal time to run to the safety of the Nifty ETF and at the same time garner appreciation. So in falling markets, you will realize that the Nifty is falling less because the weightage of the gainers is increased and the weightage of the losers is reduced on a month-on-month basis. Now that we are in the end of October, you will immediately see when you go to the NSE's website and you click on the index composition and weightages file, which is downloadable from there. Either on 31st of October or on 1st of November, you will instantly see which stock has been raised in terms of weightage and which has been reduced in terms of weightage. So this method basically ensures that in a falling market, you lose less and in a rising market, you gain more. And of course, at the same time, you're not weaving in and out of the market all the time, paying execution costs, commissions, and taxes. And of course, short-term capital gain taxes, which happen to be higher than the long-term capital gain taxes. Friends, I hope you capitalize on this fantastic opportunity, and I'll definitely be bringing you more and more updates on even more fantastic earning ideas in these videos. Do tell me what you think about this video and subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, do keep your comments coming in. I'd love to hear from you. Also, share my video with your friends and family and help me reach out to fellow like-minded investors and traders who are looking out for rational-based investments and trades based on a 30-degree worldview of the financial markets. I thank you for your patience for watching my video. I wish you have a very, very profitable day, my friends. Vijay Bhambwani signing off for now till we meet again in my next. Do take very good care of your trades and investments. Bye-bye. Thank you.